I think everyone knows the story around logistics, and hence why there are so many more people sat in the audience this year. I think everyone knows transaction volumes are up. I think the important thing is that it's not just up kind of in absolute terms, it's up relative to every other sector as well. So, there's a real percentage increase in allocation to the sector, and that's because investors are starting to understand it more. We can talk about its performance in a moment as well. I think the biggest question for this year and at this Expo is the yield compression, is the pricing that's occurred, is that justifiable? What are the arguments around this group and for everybody else in the room as to why that might be sustainable? What's different from last time? Where have we got to? Rather than the story be there's just a lot more money in the room. And I think there are probably some quite compelling stories and reasons for why we are in a different place, and that's probably just worth exploring as a group, because it will explain why everyone's doing what they're doing at the moment. And then we can also go into how people are much more aware of the types and variety of operations within the buildings, and there isn't just one standable, flexible warehouse anymore. These guys will know better than everyone else how the operations vary between tenants, and there's an increasing diversity for different operations within buildings, which is matching occupiers' expectations with what developers and owners are able to do. So maybe we can just go up and down the group a bit on that.
Our in-house view is that we're going to see more compression. Is it going to be another 100 basis points? Don't know, but it's going to be something between where we're at today and that. And it's potentially going to go as fast as we've seen, we think, over the next 12 months. And that's obviously a headache for the valuation community, because they're always coming somewhere behind. But they'll get there eventually. So I think there is more cap rate compression. There's plenty of room for it, because the spread between government bonds and yield today has tolerance for anything up to another 150 basis points on a pure academic basis. So theoretically, there's plenty of room for yields to continue to come in, which is going to be a headwind for rental growth. And that's why we're saying that, rental growth is coming, but it's softer and it's got a longer tail. And we probably think that there's room for cap rates to continue to move in that range of tolerance for the next 12 to 24 months, and then we might see a little bit of correction in some of the more mature markets. And it's a little bit what we're starting to see in some of the markets in the US, in fact, slight correction back up, but that's just normalizing to where values should be. So definitely worthy of further conversation, but I think it's going to ensure that the capital markets remain very, very healthy. On the customer piece, everything that the guys said is absolutely 100% true. But what's really, really important increasingly for customers today is, I need space and it doesn't exist. And so that's going to play, I think, significant advantage to anybody who has a development capability or can attach themselves and fund and support somebody who's got a development capability. The shortage of modern new product, or the lack of it, when you take, for example, the UK, is significant. And customers aren't churning around within old space. They're really looking to get into Class A modern products. So for occupiers, that is probably becoming the single biggest challenge as markets mature and occupancy stabilize at rates of north of 95%.
I think there's also more compression to come towards Eastern Europe. And I think that's being driven not only by the need for people to invest, but also as countries such as Romania are seeing such a huge uptake in manufacturing. And manufacturing has very much moved from west to centre. It is now really building up in countries like Romania. So I think there's going to be yield compression, quite a lot more to come in those areas. I think on the comment on warehouses themselves, James, and a warehouse, we're sitting in a warehouse now. A warehouse is a multifunctional box that goes around someone's business. And one of the great things that investors like is the flexibility of what can go into that box. And as asset managers, it's great. One day it can be racked out fully as a warehouse. Within a month or so, it could have 4 levels of multi-pick for a clothing company. And at the same time, an Amazon, an eMag may move in and turn it into a multifunctional area with warehousing one half, picking the other. That's one of the beauties. It's one of the lovely things about warehouses. They are multifunctional. And while they have that amount of use, then investors and occupiers will still want and need them.
Well, I think there is no debate on the fact that we need logistics. Everything, these chairs, this microphone, my suit was somewhere in a logistics platform before reaching us, before reaching me. So I really think that it's a growing activity. The question I raised is the following: 200 basis points of yield gap compared to prime office, prime retail. When you have a yield gap, there is a notion of risk behind that. Is there really a risk that justifies these 200 basis points? Personally, I'm not sure, and I think that it comes essentially from the fact that previously it was an alternative asset class, maybe some concern on liquidity, but we see that today it's anymore an issue. So apart from the evolution of interest rate and so on, I think that we could see maybe some sustainable yield compression through a compression of the yield gap compared to other real estate asset classes.
Great. Emmanuel, let's pick up with you.
Yeah, I think compared to 12 months ago, I think then we were probably at a cyclical low, so I'm not surprised to see capital values grow. I think we still want to look at replacement costs if you look at transactions, especially in places where there's no scarcity of product. But I agree with what has been said that there is actually a scarcity of product in good locations. It's very hard to find large spaces, and the demands from our customers is for very efficient, cost-efficient, modern logistics space. I think the logistics supply chain function has over the years evolved into something which is much more complex than what it used to be. Now it's all about being able to execute on delivery in a time-efficient, reliable way. And so logistics has really become sort of an added value activity in the whole supply chain. And what we see is that our occupiers invest a lot of money in the fit out of the warehouse, and it's a sort of logistics has become a way of a barrier to entry really to the business. So it's becoming increasingly important. The demands for location, for the way the warehouse is fit out is becoming increasingly important. So if you are in these locations, then I think you're in the right spot.
Okay, good. Mo.
A lot has already been said on these topics, but certainly I do believe that we're going to see continued yield compression, probably another 25 to 50 bips. Both on a relative basis. I think logistics is priced more attractively than other asset classes if you look at historical returns as well. So there is room for continued yield compression, certainly against the backdrop of a very low interest rate environment for the next 12 to 24 months. I think once we see interest rates ticking up a little bit in US, the next carryover could be UK, and that's going to dampen a little bit of the downward pressure on the yields. Rents are going to remain in check, but I think one thing that we have going for us is that there's hardly any spec development going on. So when you compare it, in certain ways it feels like 2006, but you don't have as much spec development coming online. So that should bode well for players who have positions in well-established logistics corridors. So, Philip.
Yeah, that's a really important point. So, in the UK, we've started to bring through, pretty modest program of speculative development in markets where there is no availability of space. And we talked last year about rents heading towards prior peak. Well, we're now signing deals on that spec space at well north of prior peak. And initially that might sound a little bit scary, and are we back to those heady days? But the reality is no, because we don't have the supply issue. And that is the fundamental difference that is helping to drive long-term recovery and long-term value in the real estate, not just cap rate compression.
Yeah, I'd just echo that. It's the availability that's different, and not just of speculative space, but of existing space. And we've just undertaken a study across, I think it's 25 different locations around Europe, excluding the major ports and infrastructure hubs and kind of slightly less obvious markets. And 90% of those locations have vacancy rates that are sub 10%. I'd say over 50% have vacancy rates vacancy rates of over 5%. So in those kind of dynamics, it's we should start to see rental growth that we haven't seen yet. It's another justification for why the yields can come down further. They're not back to peak levels yet. Well, they're not down to peak levels yet. They can get there, and they should be able to go further because we're off a different rental base. And then when it comes to development, it's not as though there's lots of land available in these locations where quite a lot of the build-to-suit requirements are coming. And the scale of the buildings that we're starting to see, particularly retailers ask for, are significant. And you can't just wander into some of these locations and put down a 40, 50, 70,000 square metre facility without it being a real headache. And you've probably got in one hand, or fewer sites than you can count on one hand available to look at. So it's difficult. I mean, we're now adopting a far more proactive occupier approach and going in direct with occupiers to go and source land directly for them to avoid some of the competition that's created. It also, if they're creating significant employment, is an easier conversation to have with some of the municipalities which they want to be located in as well. That's a slightly different dynamic from where we were 12 months ago.
The reality is in the US, which is a much more mature agent market, the businesses typically are much more invested in providing an integrated service to occupiers. Can't be ignored, and it's important that we invest alongside the agents right around Europe to complement that as we invest in that capability ourselves. But the moment in time piece is, it's still a built-to-suit world, and so there's the occupier is a hugely critical component to securing land and bringing that employment and all that comes with it. But the reality, supply for me is a measure of how much speculative space is going to come into the market, because that is feeding an anticipated demand that's there, and we just haven't seen that, which is good on one hand, but it also leaves for, in my mind, some real upside-down pricing on the development side of the world. But that piece is a moment in time. We are moving back into a place where we can drive pricing through bringing through speculative development on land that others can't get a hold of, but they need to be there. So that's really important. As a developer, having land in the best located places where you can bring competitive advantage for your customer as well as your investor will continue to be the foundation of what we do up here.